Imagine it is 2026, Tuesday morning. You walk down to the local branch of the financial institution that holds your life's work. You are not there to panic. You are just there to make your standard monthly withdrawal for groceries, for heat, for the grandkids. But the glass doors are not opening. There is a piece of paper taped to the inside. It does not say bankrupt. It says something far more terrifying. Withdrawals temporarily suspended for liquidity adjustment. What if I told you that the money you think is sitting in a vault, waiting for your golden years, isn't actually there? What if the entire promise of a secure retirement was mathematically impossible from the start? A localized Ponzi scheme that has metastasized into the backbone of the global economy. The official narrative tells you that your pension is safe. They tell you it is backed by blue-chip stocks, government bonds, and the unstoppable force of compound interest. But that narrative is a lie, designed to keep you calm while the fuse burns down. The reality is that the financial system has shifted your safety net into the casino. They are gambling with money that does not exist to pay debts they cannot honor to a generation that is about to ask for the check all at the same time. We are staring down the barrel of the greatest liquidity crisis in human history. It is not just about inflation eating your savings. It is about the terrifying possibility that when you go to cash out, the window is already nailed shut. Before we expose the mechanism that is about to freeze trillions of dollars, I need to know who is awake. Where are you watching from? And do you trust your pension fund to survive the next 24 months? Drop your location in the comments. And if you want the unfiltered truth that Wall Street spends billions to bury, smash that subscribe button right now. Let's dismantle the bomb.
To understand how we are walking into a slaughterhouse, we have to look at the bait they used to lure us in. For decades, the social contract was simple. You work, you contribute, and the system creates a defined benefit, a guarantee, a promise written in ink. But corporations and governments did the math in the 1980s and realized something terrifying. People were living too long. The promise was too expensive. So they shifted the risk. They moved us from defined benefit to defined contribution. They handed you a 401k, patted you on the back, and said, "Good luck in the casino." But here is where history begins to rhyme with disaster. In the years leading up to 1929, the market was fueled by margin, borrowed money. Investors leveraged themselves to the hilt, believing the market reached a permanent plateau of prosperity. They bought assets they could not afford, assuming there would always be a greater fool to buy them at a higher price. Today, pension funds are doing the exact same thing, but they are not using margin accounts. They are using leverage strategies and derivatives to amplify returns because the safe assets, government bonds, stopped paying yield years ago. They are borrowing against your future to pay for their present mismanagement. Sound familiar? Let's move to 2008. The global financial crisis was triggered because banks held assets, mortgage-backed securities, that they claimed were worth billions. They were rated AAA, safe as houses. But when the market turned, those assets went no bid. No one wanted them. The price was not zero. The price was invisible because there was no liquidity. The banks were insolvent for months before the public knew. Right now, pension funds are loaded to the gills with commercial real estate and private credit obligations. They are marking these assets at values from 2021, pretending that empty office towers and failing strip malls are still worth what they paid for them. They are holding toxic waste and calling it premium yield. Sound familiar? It gets worse. Look at the inflationary spikes of the 1970s. When inflation hit double digits, the purchasing power of fixed income was incinerated. Pension funds panicked. They had to chase higher returns just to stand still. They dove into risky corporate debt and junk bonds to offset the bleeding value of the dollar. Fast forward to the post-pandemic world. We have sticky, persistent inflation. The safe 2% return is a guaranteed loss in real terms. So what did the pension funds do? Did they buy gold? Did they buy commodities? No. They doubled down on risk. They moved into the shadows, buying assets that are completely unregulated, hoping to outrun the inflation monster they helped create. Sound familiar? This is the cycle of doom. Every time the system faces a solvency crisis, it resorts to fraud disguised as complexity. They hide the risk in a new box, slap a new label on it, and sell it to the pension funds. But this time, the scale is different. In 2008, it was the banks that could not cash out. In 2025, it is going to be you. The parallels are screaming at us. The leverage of 1929, the toxic assets of 2008, the inflation trap of the 1970s. We have combined all three into a perfect storm, and the ship sailing directly into it is carrying the retirement savings of the largest generation in history. You might be thinking, surely the regulators see this. Surely there are laws against gambling with grandma's pension. This is where the story takes a dark turn. This is not about incompetence. This is not about a few bad fund managers making mistakes. This is about a specific mechanism designed to hide the truth. The conspiracy requires an enabler. In this story, the enabler is the shadow banking system, specifically the world of private equity. Here is the twist. Pension funds realized they could not survive on the transparency of the public stock market. In the public market, if a stock drops 20%, everyone sees it instantly. The pension fund looks insolvent. The managers get fired.
So they made a deal with the devil. They moved trillions of dollars into private equity and private credit. Why? Because these assets do not trade every day. Their value is not determined by the market. It is determined by a model created by the very people managing the money. It is essentially letting the student grade their own exam paper. By moving your money into the shadows, they can pretend volatility does not exist. They can claim a steady 8% return year after year, even when the real world is burning down. It is a volatility laundering scheme. But who orchestrated this mass migration into the dark? Who convinced the boring, conservative pension funds of the world to dump their liquid cash into black box assets that cannot be sold for 10 years? You will not believe the name. It is not just one bank. It is a cartel of asset allocators and consultants who own the receipt to this disaster. And let me tell you, the receipt is wilder than you think. Let's strip away the jargon and look at the mechanical engine of this collapse. We need to talk about the illiquidity trap.
A pension fund works like a giant water tank. Money flows in from workers, contributions, and money flows out to retirees, distributions. For decades, the inflow was a roaring river, and the outflow was a trickle. The boomers were working, earning, and pouring cash into the tank. But now the tide has turned. We are facing the peak 65 phenomenon. In 2024 and 2025, roughly 12,000 Americans are turning 65 every single day. That is a staggering statistic. The river of contributions is drying up as people retire, and the trickle of distributions has turned into a fire hose. The tank is draining. Normally, this is fine. The pension fund sells assets to refill the cash reserves. But remember the twist? They moved the assets into the shadows. First, look at the valuation gap, or fake math. Pension funds are heavily invested in commercial real estate and private equity. In the public markets, commercial real estate values have plummeted. In some major cities, office towers are selling for 40 to 50% less than they were 3 years ago. But look at the books of the private equity funds holding your pension money. They have not marked those assets down. They are still carrying them at book value or model value. This is an illusion. It is a lie. They claim they have $100 in assets, but if they tried to sell them today, they might only get $60. This creates moral hazard of epic proportions. The fund managers get paid fees based on the $100 fantasy value, draining cash from the fund while the actual asset rots. It is parasitic finance at its absolute worst. Second, look at the redemption gate, or the Hotel California. Here is the nightmare scenario that triggers the pension bomb. As the boomers retire in 2025, the pension funds need cash now. They call up the private equity firms and say, "We need our money back. Sell the real estate. Sell the private companies." But the private equity firms say, "No." They have clauses called gates. When too many investors try to pull money out at once, the fund manager has the legal right to lock the doors. They can suspend withdrawals to protect the value of the fund. We saw a preview of this with the Blackstone BREIT fund recently, where they limited withdrawals because too many people wanted out. Now imagine that happening to every major pension fund simultaneously. Third, look at the denominator effect. This is where the math gets lethal. Pension funds have strict rules. They might say we can only have 20% of our money in risky private equity. But when the public stock market crashes, which is the numerator, the percentage of their portfolio held in private equity, the denominator, skyrockets simply because the private assets have not been marked down yet. Suddenly, a fund finds itself holding 30 or 40% in illiquid assets. To follow their own rules, they have to sell, but they cannot sell the private stuff. So what do? They sell the only thing they can sell, their good assets. They sell their gold, their government bonds, their high-quality stocks. They cannibalize the healthy part of the portfolio to feed the cancer of the illiquid part.
Let's look at the numbers, because numbers do not lie. People do. Number 1. The estimated shortfall in global retirement savings is projected to reach a terrifying $400 trillion by 2050. But the immediate gap for U.S. public pensions alone sits at a $6 trillion estimated shortfall, depending on how you calculate the discount rate. That is money that simply is not there. Number two, 2 decades ago, pension allocations to alternative assets, the risky, illiquid stuff, were around 5%. Today, for many funds, that number has exploded to over 30%. They increased their risk exposure by 600% right before the generation needed the money. Number three, the private credit market, shadow lending with almost zero regulation, has ballooned to $1.7 trillion. This is the subprime mortgage crisis of 2025, but instead of houses, it is loans to zombie companies that cannot pay their bills. Number four, when the UK pension system nearly collapsed in 2022, the Bank of England had to print £65 billion over a weekend to save it. That was a warning shot. The US system is exponentially larger. Number five, in 2022 alone, public pension funds reported their worst losses since the Great Recession, dropping by a median of 16 to 18%, and that was before the lag effect of commercial real estate crashes hit the books. Fourth, look at the Ponzi dynamics. A Ponzi scheme works as long as new money flows in to pay the old investors. For 40 years, the boomer workforce provided the new money. Now, the boomers are the old investors. The new money, Gen X, Millennials, Gen Z, is smaller, poorer, and burdened with debt. The flow has reversed. The liquidity is gone. The pension funds are legally obligated to pay checks every month. If their assets are locked in private equity gates and their liquid cash is gone, they face insolvency. They will be forced to sell assets at fire sale prices, crashing the market further, or, and this is the conspiracy, they will demand a bailout. This is an engineered collapse. The financial system built a trap where the only way out is for the Federal Reserve to print trillions of dollars to buy this toxic sludge from the pension funds. They are holding the boomers' retirement hostage to force the money printer to run one last time. It creates an illusion of wealth while destroying the currency. You might get your pension check, but because of the inflation required to bail out the system, that check might only buy you a loaf of bread. This is not just an American problem. It is a global contagion. The financial system today is faster, more interconnected, and more fragile than ever before. When the U.S. pension system sneezes, Europe and Asia catch pneumonia. The algorithms that control this capital move at the speed of light, and when the panic hits, there will be no time to react.
We are living in an era of profound denial. We look at the stock market hitting all-time highs and assume everything is fine. We trust institutions simply because they have existed for a long time. But Rome existed for a long time before it fell. Lehman Brothers existed for 158 years before it vanished in a weekend. These institutions are built on borrowed time. They are playing a game of musical chairs where they have sold 100 tickets for 10 seats. The music is slowing down. The boomers are stopping their dance. And the liquidity, the very air that keeps this system breathing, is being sucked out of the room. The retirement lock-in is not a glitch. It is the inevitable conclusion of a system that prioritized quarterly fees over generational security. They have locked your capital away to save themselves. You need to be skeptical. You need to be prepared. You need to understand that in a liquidity crisis, possession is 9/10 of the law. If you cannot touch it, you do not own it. Do not let them gaslight you into thinking this is normal. It is not normal. It is a mathematical crime scene. Are we wiser now, seeing the gears of the trap? Or are we just walking the same path as 1929 and 2008, only this time in better suits? If you want to survive the wealth transfer that is coming, you need to stay informed. Share this video with anyone who is counting on a pension. Wake them up and hit that subscribe button, because the next crisis will not wait for you to be ready. I will see you on the other side.